Hi, guys, and welcome back to the next episode of Bonds. We're just going to carry on from where we left off last time. So, we spoke about a couple of different things. We spoke about the coupons, we spoke about which is the interest on bonds, we spoke about the maturity, which is when the bond actually uh, got to the end of its life cycle. We then want to speak about how bonds are priced because that has an impact when it comes to buying a bond. We also want to speak about the face value of the bond and a couple of other bits as well when you're looking at bonds versus cash. So, if you're looking to purchase a bond, you want to understand the price of the bond. We've talked about the coupon, we've talked about the risk of the bond. If it's a high risk bond, you want it to give you a high return than a lower risk bond, right? And if you're then looking to understand the price perspective, there's different elements for you to that you need to consider. So, think about a bond that is priced at 100, 100 being what we call the nominal value of a bond. So we don't make it too complicated. Just think about the basic value of a bond. Any single bond is going to be 100 units of currency, right? And that bond can then be sold at a premium, which is a price above the 100, or it can be sold at a discount, which is a price below the 100. You truly want to understand the price point at which you're buying a bond because remember we said that when the bond gets to maturity, you then redeem that bond, which means you get your money back, which is called the principal. So, if you purchased a bond at a discount, you could say perhaps that you purchased the bond at 90 units of currency and now you're getting to redeem the bond at maturity, which means you're getting the face value of the bond or the nominal value, which is then the 100. The difference between the 90 and the 100 is actually a gain you're making on that bond. But that's not the standard way that bonds are valued. So you need to understand why this is the type of pricing strategy that that particular bond is using. So let's think about this. Bonds are issued consistently, right? And interest rates impact the value of the bond over the long term, or the value that you're getting from the bond as well over the long term. So if you say you purchase a bond today at a 5% interest rate, and that bond is a fixed bond for a period of 5 years. Now, give it a couple of months, interest rates go up, and now the new bonds are being issued at 8% interest over a period of 5 years. You're going to feel like, actually, I've lost out because I purchased my bond 3 years earlier. So, what happens in the market to be able to provide for, I guess, the devaluation of that initial bond? This is where the pricing comes in. So, for the market to be able to maintain a bond structure and a bond price that remains attractive to investors over the duration of that bond, they will then have to adapt the price to be able to remain competitive. Remember, the new bond is coming in at a new interest rate, at a higher interest rate, which makes it more attractive for investors. They then have to look at the old bond, which means they're now going to sell that bond at a discount. And the discount they apply is essentially going to make the bond competitive with the new bond. So over the life cycle of that older bond, if you think about the discounted price, which was not 100, it's now 90, and you think about the 5% return you're getting on that investment, and then you compare it to the new bond issued at 8% return at a price of 100, over the duration of both bonds, then the return that you're going to be getting across the two shouldn't be too dissimilar. That's the way that the market prices the bonds to be able to allow them to remain competitive and ensure that investors are not, I suppose, discouraged from investing in older bonds, right? So you might wonder, why should I invest in a bond versus holding cash? You're telling me I'm getting a return of 5 to 8%. That's essentially what I'd be looking to get in a cash sort of ISA, maybe a fixed high yield savings account. So why should I look at a bond? This is where it gets very interesting. You would be looking at inflation linked bonds, which means as inflation adjusts, the value of the bond is not uh, negatively impacted by the change in inflation. So the bond is going to move in line with inflation, which means the value of the bond is not eroding significantly over time, as opposed to cash. If you're holding cash that's giving you a 5% interest, yes, you've got that. But as inflation keeps rising, if you fix that cash in a fixed high yield savings account or an ISA, then the value of that bond is, oh, sorry, the value of that cash is going to deteriorate over time as long as inflation keeps rising. So you've got the five locked in, but inflation goes up higher than 5%. It means that your cash is being eroded in value. So that's an important distinction to have when you're trying to determine whether or not you should be investing in cash or putting your money in bonds. And particularly for people who are looking to make significant purchases in the short term, you're looking to buy a house in the short term in the next, 12 to 24 months. Think about whether holding that cash in bonds is actually beneficial for you. It may be, so it's worth considering, right? And the other thing is this, because for the sort of mid to longer term investors, when you're thinking about holding bonds in your portfolio, the reason why that may be more attractive than cash comes back to the fact that it's linked to, you might get assets that are linked to inflation. The second thing, you have a fixed interest. So remember, cash, if you're investing in a high yield savings account or a fixed uh, savings account, or wherever it is you're putting your cash, you would be locked in for a period because you could fix that. So you're getting 5% on your cash. Say inflation happens, that's not adjusting for inflation because essentially it is fixed, right? In addition to that, you've also got the fact that when that product ends, you now need to get into a new product. Interest rates may have dropped. They may have now dropped to by 1% or 2%, which means that 5% you got before is not in existence, 2 years down the line. Whereas with a bond, once you've locked it in at the 4%, the 5%, the 6%, the 8%, and it's a 5 year bond or it's a 3 year bond or it's a 10-year bond, that is the fixed interest you're going to be receiving on that bond. So it's important to have that in mind when you're thinking about investments that are more safe, right? That give you a bit more comfort, that don't expose you to too much risk, and that give you that diversification in your portfolio as well. So remember that I've said that when it comes to bond investing, you want to think about factors around the duration, how long you're going to hold the bond for, the coupon, which is the interest rate, the face value of the bond as well, is going to be important for you to think about. Inflation, whether it's linked to inflation or not. Um, and again, you want to understand the risk profile of that bond and really compare whether a lower risk profile bond is giving you a higher return than a higher risk profile bond, and understand why that would be the case. So we've come to the end of the bond series. I hope it's been useful. Give me your comments. Let me know if there's any information that potentially you feel that I could have expanded on or you want to hear more about, and I'll be happy to explain that in future episodes. Um, there are other ways that you can invest in bonds as well, which is not just going through an individual bond. You could invest in ETFs when it comes to bonds, but I will cover that separately as well, just to expand a bit more in terms of how you can hold bonds in your portfolio. As I've always said, pensions are definitely a way that you can understand how investments work. So when your pension fund is investing in bonds, they do give you a lot of information in the sort of accounts or in the benefit statements that they're sending to you, different communications that they're having with you. So definitely use that as an access point to understand the reasons why your pension fund is investing in bonds, and consider, would that be useful for my portfolio? And we've seen that in both cases, for short term and long term investment strategies, similar to pension funds, bonds are very much applicable. So, for your personal investment portfolio, I would believe that bonds are very much applicable to your investments. Thank you so much for joining me, and I will see you next time. Bye for now.